Let's get going. Good morning, everybody. So this week, a few items of news as normal, and then our guest this week is Peter Hewitt, who's the manager of the BMO Managed Portfolio, which is an interesting film, interesting structure, and holds lots of investment companies. So I'm sure you're going to have plenty of questions about the fund and what it's holding. So let's start with the news of the week. I wanted to mention a few things. So the first is to look at the US solar funds. So US Solar and Ecofin US Renewables. Quick mention of CQS New City High Yield because it published results this week, and also Genesis Emerging Markets. So solar funds first. The US Solar Fund is a bit older than the Ecofin US one, and they've both been fairly flat since launch. Really, I mean the complicating factor in all of this is that they're priced in dollars. And so the variations that you see in the share price and the NAV are really driven down by the currency. But as you can see, that the premiums have been fairly consistent, a bit more punchy for the US Solar Fund, and more modest for the Ecofin one. But I think both of them have got a reasonable chance of carrying on expanding. If we carry on going, there's the state of play at the moment. So the Ecofin has been newer, is a lot smaller. I'm hoping it's going to raise more money, as we'll talk about in a second. That yield of 1.6 is just based on what it's paid so far. It's actually aiming for something close to 5.5 in the end, and we'll see that coming through, hopefully. And that will put it up with it alongside US Solar, which is similar sort of ambition. As I say, the US Solar Fund targeting returns about 7.5% a year, a little bit more than that if they can. And then this initial dividend target was 2 to 3, rising to 5.5. Obviously, with the portfolio fairly fully invested, it's been able to pay the full dividend now. Whereas the Ecofin one launched just last December, so it's only just over 6 months, well, 9 months old. Raised $125 million, which I'd like to be an awful lot bigger. We'll have to wait and see. Again, similar sort of return objective and similar sort of yield objective. It's slightly different in that it's got this dual share structure. So it's got sterling shares and dollar shares. They are the same thing. They just have two different quotes, and you can hold either of them. It's not two different portfolios, so they're exactly the same thing. I've shown this slide before, I think. It's from one of the notes that we did relatively recently, and it's just underpinning the reason why renewables in the US are actually taking off. This levelized cost of electricity is basically trying to compare the cost of generating electricity from installing the kit and running the kit and all the rest of it to come up with sort of price that makes sense for comparison purposes. And as you can see there, the solar is looking like it's going to work out to be the cheapest form of generating electricity, all in. That includes the benefit of some tax credits. So both it and some onshore wind, they have tax incentives for when they are setting up shop, when they're actually building the plants, and then some production credits as well. But these are sort of variable. Biden's been making plans to extend these properly. So the industry's been coping with a sort of slightly uncertain regime under Trump, and now obviously looks an awful lot better under Biden as he makes all these climate change promises. And you can see that the result of all of that in these charts that I've made from the US Energy Information Administration. And first one is the yellow bars is just showing you the shipments of PV modules, so solar photovoltaic modules. And you can see they are going up as more and more of this stuff is installed. And also you can see that renewables in terms of is edging up importance in terms of the US generating mix. They're an awful long way behind where we are in the US, and so in the UK and Europe. But they are planning to take us on and install an awful lot of capacity. So that does mean that for both of those funds, there is a huge amount of stuff that they can invest in. They're not going to run short of projects to fund. US Solar's got 42 projects so far, almost 500 megawatts. All of these are now operational. It started off investing in things that were under construction, some cases, but they're now operating. Now, one of the keys, the reasons that I like these US funds is that the revenues are contracted for long term. So they have these power purchase agreements that run out for about 15 years, sometimes a bit longer than that. And the reason why that's attractive is obviously you should be less sensitive to short-term moves in power prices. Having said that, US Solar came out this week and said that its NAV had been marked down by 2.8% over the first half of 2021. And it blamed lower merchant power prices for that. And I was quite surprised by that. So it's one of the reasons I thought we'd talk about it. They are saying this just applies to the periods between the sort of end of the 15-year average power purchase agreement and the end of the expected life of the asset, so 35 years. So what we're talking about is a shift in the prices over the very long term. It's using independent forecasters to come up with these, just as firms do in the UK. And what we've seen since the end of June is the price forecasts are going back up again. So they came down for COVID, but that should have been a short-term thing and shouldn't have affected them. And they're going back up again, I guess, because gas prices are going up everywhere, and so power prices are going up everywhere. It seems strange to me that these short-term moves are affecting the long-term thing. I think it might be, even though this is what the company has said is the reason, it might be more along the lines of the gradual cannibalization of new renewables, of power prices, which has been talked about for, around the whole of the industry, which we don't really know how that's going to pan out, but I think that might still be an issue. But nevertheless, when it comes to renewables, these funds are better placed than the ones in UK and Europe that are allowed on selling their power. Here's where the charts from their interim report, just showing how these things have changed. So you can see that it's very marginal change, and I suppose it's a very marginal movement in the NAV, only 2.8%, but it's very marginal change that did this. And you can also see in that figure 8 there that I've stuck on there, that the prices are edging up. This is what they've said, that they're edging up again post-July. So there we go. We'll just have to wait and see how that works out in practice. But on that basis, they're kind of hinting that the NAV is going to go back up again when they do it again in the end of December. Here's the EcoFin fund. It's obviously much smaller, but it's getting to be fully invested. So this is what it's got. It's got a longer average power purchase price agreement, 18.3 years, which obviously means it is slightly more protected than the US solar is. And it's busily, as I say, investing. In July, it committed to spend $95 million on 12 projects, and they've closed the first of these this week, which is another reason why we're mentioning it today. So they've got $30 million that yet to be committed. But they've got a pipeline, a near-term pipeline of about $100 million, plus they're bidding on another 112. So what I think this is a heavy hint is that although they're taking on more debt, and that obviously helps the returns, we are probably looking at some more share issues for this one coming up very soon. And as I said before, I think this is a good thing and to be welcomed, and I hope it manages to achieve that. So that's that one. CQS New City High Yield. I quite like this fund. It sort of pays an enormous yield. It's not huge, but it has been growing. It consistently trades at a premium normally. It had a big wobble with the COVID panic last spring, and you can see that in the NAV and the share price there. It's investing in loans and bonds that are quoted, so the NAV shift represents a real drop in prices. It's not a mark-to-market thing on sort of expecting losses. So prices of bonds invested in fell. Discount widened out for a bit, but very, very short-term opportunity. If you managed to buy them then, well done you. But we're not quite back to where we were in February 2020. And I think this is probably indicating that there's still a bit of an opportunity left here, although you can see how things are trending back. Here it sits in its sector. So there are funds in there like Henderson and Invesco that tend to invest in investment grade and good credit, quality credits and high yield. The CQS fund is sort of hunting out smaller, more interesting issues that the others maybe wouldn't look at because of liquidity reasons. I mean, having said that, the top holdings are relatively liquid within the fund, and we'll have a look in a minute. But it's going and hunting for yield in all sorts of places, and that's one of the reasons why it's managing to achieve a much higher yield than the others are. For the period that we're talking about now, which is the 12 months to the end of June, its revenue was impacted by what's been going on. There were a couple of things that got hit, and it's had to decide what is. They have decided to increase the dividend, but they're having to do a bit of that from revenue reserves. They've got plenty of these, so that's not an issue. They think they're going to have to do that again next year, or the year we're currently in now. But that doesn't seem to be a problem. So we can expect that yield to be maintained for the moment, which is good. It's 8%. And not surprisingly, given that sort of level of yield, it attracts attention and it's been issuing shares, 12.2 million shares at the end of June. It's not achieving that yield through gearing. So it has got some gearing and it comes very cheaply, as you can see there, but it's only 10% of the fund. So it's not the financial engineering exercise that generated this. As I said before, it's just down to stock picking, whatever the equivalent is in bonds. And here is the portfolio. So there are a few weird wonderfuls in there, as I've said before, and you see things like Raven Russia preference shares in there. That's the Russian warehousing funds. It's in our sector technically. VPC specialty lending's in there as well. One of the ones that they've had problems with, that's why I did show the whole top 20, so the top 10, is Matalan Finance. That was obviously hit very badly because they had to shut the shops. And its turnover and revenue fell quite significantly, and the price of the bonds dived. They are drifting back up again now, and the decision to hang on to these is sort of worked out quite well. There are all sorts of things. There's quite a strong bias to financials. We have written notes on it before. If you want to have a look at it and read more about it, we've got a note I think we published in April. We'll probably be refreshing that in a couple of months or so. So an interesting one for you to have a look at. I just thought that those results were worth pointing out. Then, there we go. Lastly, Genesis. Slightly strange statement this week from the investment management company. So we are almost done with this. There's an EGM scheduled for next week to approve a new investment policy, and because it's going to be taken over by Fidelity, it's going to become Fidelity Emerging Markets, and there is a 25% tender offer planned next week as well. Genesis is on its way out. It's getting paid out. It's around the notice period, so it's got no reason to gripe really. But the tender offer, which it says for 25%, which will happen over the course of the month, providing that shareholders approve it at the EGM, they're saying it's a bit too small. So the argument is that because the policy is so different, so when it goes to Fidelity, it's going to be using derivatives and shorting to try and enhance and smooth returns that way. It also may invest in some unlisted stocks, things that Genesis haven't done. On the back of that, the Genesis Emerging Market is saying that investors should get the option of a full exit if they want to. With the register of this, as with a lot of these emerging market funds, is very concentrated. And I would assume that all of these people are being consulted already. but it doesn't take, it doesn't, you know, as you can see from here, if a couple of them say, actually, I want all my money out, it doesn't take much to exhaust that entire tender offer capacity, and then you've got an overhang of shares on the new fund, which is probably not something you want. If the what the Genesis investment managers are saying sort of rings a bell with some of these investors, their only option now is to vote down the deal. I think that's quite unlikely, so I think we might be too late for this, but it's just something to watch for next week to see what happens at the CGM. So there's a question there, why did Genesis get the boot in favour of Fidelity? I think it was just down to the rating, actually, to the discount. They never really managed to capture their own imagination and convince investors to buy the fund. Performance went in and out. Sometimes it was good, sometimes it wasn't. But they weren't very good at marketing it. We pitched for it at one point and they said no, more for them, but there we go. We'll wait and see what happens. The other question up here is, have we had Ian Francis on the show? I don't think we have, actually, and I think that's not a bad idea. So, as you know, I don't get to do these. Well, I do get to have holidays every now and then. So, Matthew Reid, who is our expert on this fund, I think he'd be quite good for him to interview Ian one day. We'll get that arranged. I think, to ask the last question, when GM goes to Fidelity, will it be shorting indices or individual stocks? I think it's just indices, but I'd have to go away and check that. We'll see. All right. So enough from me.